If you've ever read economist Jim Rickards' book Currency Wars, you see a good explanation of how nations manipulate their currencies to gain an economic advantage in trade. If you dilute the value of your money, it makes your goods more attractive to other countries because your items are cheaper to buy. So nations have been trying to undercut each other for a long time, manipulating their currencies, using things like inflation to make their currencies less valuable, hence more propitious for exports. In the book Unbalanced by Stephen Roach, he talks about the codependency between the US and China. America has set itself up as the big consumer market of the world, whereas China has positioned itself as being the big producer on the planet. They feed into each other like a feedback loop. Trump used to complain about America's whopping trade deficit with China, but Roach makes an interesting point. Countries that have low savings rates will always run huge trade deficits. Why? Well, let's first point out that China has one of the world's highest savings rates. It's nearly double the global average at 44%. The Chinese are huge savers. They have to be. Since the one-child policy, you have all these single adults scrimping to be able to pay to support their retired parents. People in China don't have the discretionary income to, say, go to Disney World or to indulge in luxuries. By contrast, in America, the United States doesn't save. The problem is not just individuals, but the entire economy. America's broadest measure of domestic saving, the sum of depreciation adjusted or net savings of businesses, households, and the government sector, fell into negative territory in 2008 and plunged to minus 2% of national income in 2009 before easing to minus 0.8% in 2010, and then inching up to just 0.4% in 2011 to 12. This is the largest shortfall of a leading nation in modern history. Americans don't save. In fact, they're pretty much broke. As a result, it's hard for the average American to buy stocks or invest in the system. Our leaders like to use inflation to discourage saving. After all, if money's losing its value, you're more likely to run out and buy stuff or else you'll lose out. Federal Reserve notes aren't a store of value, hence they don't serve a critical function of money. In reality, what we have is currency, not money, and the Fed likes to dilute it to facilitate liquidity. So the very system itself discourages Americans from being savers. Luckily for America, a lot of countries around the world do have savings, and they use those savings to invest in U.S. government treasuries and in American corporate stocks. It's how our government and corporate sectors have stayed afloat. But watch how that negatively affects trade here.
Now imagine the following. Suppose that in the US, indeed, the savings are actually less than the investments. So the domestic savings are less than the domestic investments. In other words, in the US, some of the domestic investments cannot be funded with the domestic savings. There is basically a shortage of capital to fund all those investments. Now, that shortage of capital won't come, falling from the sky, so it has to come from somewhere. It could come from abroad, especially if you have an attractive interest rate that will attract foreign investors. It could come from abroad. It could come, for instance, from Japan. It doesn't have to come from Japan, but just as an example. Now, imagine the following. Suppose that Japanese investors decide to basically fund the shortage of capital in the US. And again, they fund it and they get a nice reward for it in terms of an interest rate or whatever. But if they want to fund it, they have to take into consideration that in Japan, they use the Japanese yen, and in the US, those investments, they must be, they have to occur with using the US dollar. So when this huge influx of capital from Japan goes in the US, you basically have Japanese that are converting their Japanese yen to US dollar. As such, the demand for the US dollar will go up, which will make the US dollar obviously a lot stronger, okay? So it will make it a lot stronger relative to the Japanese yen. Of course, we keep all other factors constant, otherwise the model would be completely polluted. Now, what I want you to think about is this. When you have a US dollar that is stronger and, by comparison, the Japanese yen will become weaker, what does this do to your import-export status? Well, the US, with a strong US dollar, can import easily, and exports become harder. In other words, it will most likely run a trade deficit. Okay?
Wall Street loves getting all that foreign direct investment. It's allowed them to sidestep Americans and get foreigners to pump up the stock market and to buy into their unproductive zombie companies. According to the Tax Policy Center, who owns American stocks? Foreigners and rich Americans. Our new analysis shows that foreign investors owned about 40% of U.S. corporate equity in 2019, up substantially over the last few decades. Currently, America runs trade deficits with 110 countries around the world, and those countries, in turn, buy U.S. stocks. See here. Statistic tracks U.S. corporate stocks held by foreign residents. No surprise, we see the Cayman Islands, but then there's Canada, the United Kingdom, Luxembourg, Japan, and so forth. If Trump had fixed the trade imbalance with China as he campaigned on, then that would have stopped these foreign flows of money. The stock market would have been devalued. Wall Street wouldn't have been able to rely on all that foreign capital and would have had to be competitive again. The age of the unproductive zombie company would have been over. They didn't want that. Of course, if Trump had gotten his way and fixed the trade deficit, that would have helped U.S. manufacturing and created jobs at home. It would have made us more competitive overseas, and with all those new factories, that would have helped American working class people get jobs again. But then, the Wall Street class wouldn't have been able to have the gravy train keep going. They got used to all the free money from overseas. Cash earned not through productivity, but through free money from foreign savers. It was like heroin. The Business Roundtable and the Chamber of Commerce decided there and then Trump had to go. Advantages that now accrue to the 1% would have trickled down to the unwashed lunch pail crowd, and they couldn't have that. Our wealth would have been based on productivity and not what Stephen Roach calls the gospel of false prosperity, bubble-based paper profits. Of course, a hard rule of economics is that you can't print your way to prosperity. Wealth is only created in only three ways. You can mine it, you can build it, or you can grow it, but you can't print it up on a fiat counterfeiting machine. You can't print a steak dinner, or an Xbox console, or a barrel of oil. Trump wanted us to go back to the true wealth of productivity. But had he done that, it would have revealed what a sham our economy has become. And it also would have diminished the influence of foreign money in our country, because there would have been a lot less of it. In other words, we would have had to work for a living again. And that's all that the average American wanted for a long time. But the idle rich who run the country had other ideas. By the way, I just wanted to make my audience aware that I wrote a book entitled Actionable Ethics, and it's now up on Amazon.com in both paperback and audiobook format. If you're interested, check it out. Of course, you should be more interested in the New American magazine, which you can find at thenewamerican.com. The authors there are much better writers.